Right, thank you very much, and thank you for the introduction. You've actually covered the first slide or two. I've been in the city, in the London financial services space for the last 30 years. As mentioned, Barclays Capital, Salomon Brothers, Lehman Brothers, names which aren't around anymore, for which I take no personal responsibility. But after I moved into consultancy, I found that there was a real need, because I'd been in technology, I'd been in compliance, I'd been in controls. I found that there was a real screaming need for someone to look into regulatory reporting and help people to understand how to report in a compliant manner. So that's what I've been doing for the last 10 years, or certainly until the beginning of 2019. Then there was a little bit of a flip, and I switched over to Coinbase as the head of compliance. I'm not kind of expert in the blockchain. You can't, as far as I can tell, as an ex-COBOL programmer, the blockchain looks to me like a serial file with append permissions, and I can't get my head around anything beyond that. But the regulation of crypto is a very narrow field at the moment, and I think I've covered it all from the UK point of view, because there have been a couple of consultation papers out this year. I've responded to them all, and I'll be covering some of them in this session. So I became Regulatory Advice Limited just as of beginning of October. Apologies to anyone who thinks that it's been a bait and switch. You were sucked in on the understanding that you'd be seeing the Coinbase head of compliance. I actually still am, but since the beginning of October, it's been on an interim and part-time basis, because I've moved off to do what I like best, which is one-man band boutique consultancy. One of the things that I particularly like about that is that I don't have lawyers and marketing departments telling me what I can and can't say. In fact, this session was initially booked under the Coinbase name, and when they saw some of the things I planned to say about the FCA and the regulations, they said maybe you can do this under your own banner. So that's about it. I really want to go through. It's a bit like crypto past, crypto present, crypto future. It's a bit tones of the Christmas Carol in here, but I just wanted to tell you how we got to where we are, and then what's happened in 2019, which has been a lot of discussion, and I'm not sure that it's moved us any further forward. And then we'll have a little chat about January of 2020, when something real is happening that you have to really prepare for. So let's roll back a couple of years ago to when there was really no cryptocurrency regulation in the UK, and a few people, including Coinbase, went and got an e-money license. Now, it's news to some people. It was news to me when I joined Coinbase earlier this year, that actually there was no need to get an e-money license. Even if you are going out to have fiat rails, if you're providing people with a fiat wallet to go out and buy cryptocurrency, there's still no need to actually have an e-money license. Because one of the criteria of e-money, there's three main criteria. One of them is that the e-money should be spendable with someone other than the issuer. Now, if you're an exchange and you're setting up someone with a sterling or a USD wallet, your expectation is that they come to you and you alone to buy cryptocurrency. So you can just treat it like e-commerce. You can just treat it like you've got an online account. It doesn't have to be e-money. You don't have to be registered. But a couple of years ago, there seemed to be some good reasons why you might want to get an e-money license. One of them was just that, to be visibly regulated in a market where everyone was assumed to be cowboys, and really the banks wanted to see you regulated before they would give you an account, and even then it was touch and go. And also you wanted to get some permissions that you could then passport into other European countries. So for all of those reasons, it was kind of made some sense. It certainly was good. It got a bit of a splash for Coinbase, being the first in to get an e-money license. They've just done the same thing in Ireland as a Brexit hedge, because if we become Fortress UK, then the Dublin office can passport into all the other EU companies. But some of those reasons fall away from next January. For one thing, all the crypto firms are going to have to be regulated, at least from the point of view of anti-money laundering and KYC controls. So you've got that, and the banks can sort of depend on that, and they don't have to worry so much that you're just going to let anyone through the door. And of course, if we end up at the end of January as Fortress UK, then you wouldn't even if you're set up as an e-money institution here, you wouldn't be able to passport into other countries. So less stress on the positive points of getting an e-money license from January. On the other hand, there are some real negatives. One is, for a start, I don't like any kind of opt-in voluntary regulation. In the transaction reporting space, where I spent a lot of time, there was an exemption for asset managers all the way up to MiFID II. Asset managers could just rely on the broker's report, and they didn't have to do any report of their own. Some asset managers decided, well, just to be on the safe side, we are going to report. Problem is, if you do it voluntarily, you've still got to get it right. And I did a review for a very large asset manager who had decided to go on the safe side. They reported everything. And when I reviewed it, it took like half a day to see they'd reported everything wrong forever, because they'd taken their transaction reference number and put that into the client reference number. So if they did 10,000 trades, it looked like it was with 10,000 different clients. They got caught. They didn't get fined, but they had to back report millions of transactions which they never needed to report in the first place. So hence I'm not a big fan of opting into something just to look good. And there's lots more to the e-money rules than just financial crime. In fact, there's about 20 chapters in the FCA's approach document, only one of which is financial crime. All the rest of it is things like notifications. Do you have exactly the right text at the bottom of every email that goes out to your client? Have you got the right safeguarding? Are you safeguarding in the right kind of account, which has to be an EU credit institution or bank? Have you got the right capital set aside? All of these are things which, as crypto firms, you might not really be thinking about a lot. And suddenly you'll find you could get all kinds of reputational damage. You could lose the license when you didn't need to have it in the first place. So why is this all relevant? Why am I rehashing all of this? It's taking a long time to get these people across the line. It's typically a year or more to get an e-money license for a crypto firm. There are lots of people in that queue, and what I'm going to suggest is, if you haven't got it by now, maybe you don't want to carry on with that application. Maybe you wait and you get authorized and registered for the AML functions in January, and you forget about the e-money license because it's not necessary and it could lead to some real downsides. Happy to discuss that further, but I suggest if you haven't got your e-money license by now, it's probably not worth continuing with it. So that's the past. What's happened this year? In 2019, there's been an appearance of lots of activity. There's been lots of discussions, and this is, don't take a photo, don't take notes, because this all changes. This was the initial consultation that the FCA came out with, which was trying to show what's within the regulatory perimeter and what's outside. They subsequently simplified this a lot, as you'll see on the next slide. I just wanted to point out how it broke down in the initial consultation, because it's actually it was useful in that it reminded us that the Financial Services and Markets Act 2000 had this concept of a designated investment. Designated investment is far larger, far broader than just equities and bonds. And this gives you an idea of some of that. Some of the rights and the certificates and the collective investment schemes and things are all covered. They're all inside the regulatory perimeter. And you have to remember that when you're designing tokens, that if you do something that's based on lots of different underlyings, maybe it's becoming getting caught by the collective investment scheme rule. Maybe if you're doing a token that's based on something else, it's effectively a certificate or a right over something. It was good just to give us that reminder that you have to be very careful when you're designing a token if you want to avoid being caught by the regulatory perimeter. There's no specific discussion of derivatives. There probably should have been, but they came up with their own derivatives consultation a little later, which we'll get onto. I just put this up as a sort of reminder of where we start now, because we ended up with something far simpler. And I'm grateful to Compliancy Services. Ben Mason did a slide very similar to this. I've kind of taken the structure from it. It ended up with them just saying, do you know what, let's forget about utility tokens, exchange tokens. Let's just say there's regulated and there's non-regulated. And that's very good. It's good to split things up a lot before you then lump them together in logical groupings. So now they're saying non-regulated is what they used to call exchange tokens, what they used to call utility tokens, and regulated is all of the security tokens, everything that triggers that designated investment under the FSMA 2000. And also derivatives are understandably regulated, by which I mean futures and options, CFDs, spread bets. They actually even include ETNs, exchange-traded notes, which is debatable whether they really are derivatives. But they split it out like this. You would think this is the final position paper, this is the policy paper that came out from the FCA after they'd done the consultation and got all of the responses back. So you might think this is pretty much final form, and I say no, it isn't. I don't know what you think of this, but e-money tokens, I think they have the idea that because e-money is superficially like stable coins, they think it's going to be regulated. Stable coins will be regulated as if it's e-money. Why I say it's superficially like it, with a stable coin, you issue a stable coin, a USDC or USD Tether, and you took away a dollar. In the best case, you took away a dollar in a vault somewhere. You do pretty much the same with e-money. You issue a pound of e-money, and you took a pound away in a safeguarded thing. But actually, the pound that gets tucked away for e-money is linked to the individual who has the account. The dollar that gets tucked away for stablecoin is linked to the coin. So the coin can travel around the world and be encashed, can be redeemed by someone completely different to the person who initially bought it. Whereas e-money, as soon as you make a payment out of your e-money account, your e-money that's set aside in the vault, or your payment that gets set aside in the vault, gets debited and it gets flattened out. Superficially similar. I don't think that the e-money rules are ever going to apply fully to stable coins. Derivatives. I mean, there are a couple of these things where the regulator is unpicking this almost straight away. Derivatives, they've come out with something saying, let's just not do it. For retail clients, let's just not do any derivatives based on cryptocurrencies. They're also thinking, HM Treasury is saying, well, let's have a look at the regulatory perimeter and see if we move this dotted line across to the left. Now, imagine that all of this is treated as designated investments. How are you going to satisfy some of the MiFID requirements on Bitcoin or Litecoin or something like that to assess the suitability of that as an investment for a particular retail client or any kind of a client? It opens up a whole mesh of problems. On the other hand, look at utility tokens. Utility tokens, I have this problem that they started out saying, no, they're very different. Now they're saying they're essentially the same as exchange tokens. We're going to regulate them in the same way. They're outside of the regulatory perimeter. Now think about something. If any of you have a financial services, traditional financial services background, think about something which locks in the price of a product or service at some time in the future. You lock in the price of file storage or network bandwidth or something for the future. That starts to sound a bit like a forward, doesn't it? It sounds like a commodity forward to me. Now add on the overlay that You don't have to, you're not locked into that. You can cash it in for that product or service, or you can choose not to. Now it sounds a bit more like an option. And there's a whole raft of regulation already out there to deal with forwards and futures and options on commodities. So I think that I don't feel like they've bottomed out the analysis of these tokens yet. So I've got problems with the utility tokens, with e-money tokens. I really have problems with them trying to ban derivatives for all of the retail investors. So let's have a look at the security tokens. These are all the caveats, all the things that I don't think really stack up on the previous slide. ICOs, IEOs, IDOs, there's a whole raft of them. I mean, ICOs, everyone knows the initial coin offering. This was what happened in 2017. The actual issuer, the people who had the development project, issued the coin directly, and it might have been a scam, might have been fine. After they'd issued it at some stage, they had to run around and try to get it listed on an exchange so that the people who'd bought them could actually do secondary trading in them, which was where a lot of the value came. IEOs gets past that problem because it's initial exchange offering. The exchange does some due diligence and they go out and check that it's a real project. It's got, they haven't just copied and pasted the white paper from somewhere else. It's got some substance to it, and that's very reassuring to the investor. IDOs, initial distributed exchange offerings, I see that as being a bit of a step back from having an exchange do all the due diligence, but there are some of those out there. All of those are still possible in the UK without any problem, as long as it's on tokens which are not regulated tokens. So if it's not qualifying as a security, do your ICO or your IEO or your IDO, you're going to be fine. Until January, when you're going to have to do some anti-money laundering controls and checks on everyone who comes in and buys. In fact, it's probably sensible to do that now. We had the case in Coinbase where people would just get in money from wherever. They get it in loads of Ethereum, and then when the ICO company decided they wanted to actually fund their developers, they'd come and try and cash out that Ethereum, and they'd find no one would take them on because no one knew where that actual initial money came from. There was no real due diligence done by the ICO. So from January at the latest, everyone is going to have to do know your customer type controls. So the one thing that we have got from this previous slide is security tokens are regulated and they need to follow all of the same rules as equities or bonds or whatever. So how does that work in practice? People who've tried to do this, they've found there's a bit of a problem, because before you can set out something that's a security, you have to do a prospectus. The prospectus has to be signed off by the FCA, and and there are just a couple of exemptions that people are typically trying to use. If it comes in under £8 million, if it's only offered to qualified investors, then you can get around that. But even if you get around it, even if somehow you bypass the prospectus regulation and you get your token out to UK citizens, you've still got the problem that it's a security. Before you can do anything else with that security, you're going to have to follow the MiFID rules. So if you want to offer people a secondary market, you're going to have to go through the MiFID rules of setting up an MTF or a regulated market, or at least set up a brokerage under MiFID which can pass these things on to another exchange. Typically, and this is very unwelcome news to people who are trying to set up STO exchanges over here, typically that MiFID regulation, that MiFID authorization, costs over £1 million, and it takes over a year, and it's not guaranteed. Now, most people from the crypto space, that doesn't compute for crypto years. People will run for the exit at that point. I know that Archax, who I think are around, or at a fairly advanced stage of getting an MTF set up to do exactly this. I'm working with a group called Next Hash Group, which is doing exactly the same, trying to set up an STO exchange which is compliant, even though it's going to take them a long time and it's going to cost a lot of money. just wanted to quickly talk about the prohibition of retail derivatives. This was a consultation that came out. We haven't seen the position paper coming out of this yet. It was a nonsense, real nonsense. The reason why is they lumped in exchange-traded notes. Exchange-traded notes, they're exchange-traded. There's already due diligence being done by the exchange to make sure that it's legitimate for listing. Because it's on a market, because it's on a regulated market, it has all of the price manipulation controls, all of the trade surveillance going on. So it's really, and in the appendix to their consultation paper, they actually proved with their own statistics, with their own numbers, that people who had ETNs over 2017, 2018 had a better result than people who just did a buy and hold strategy. But they disqualified the positive, they filtered it out and said, but this doesn't mean that it would be any good in the future. ETNs aren't really derivatives. They might have a reference to a crypto asset price, but they're just like equities or any kind of bond instruments. Even when you get to the prohibition that they're suggesting on CFDs, the CFDs on crypto showed a 67 to 72% customer loss over the period of time. If you go to any CFD provider's website now, under the ESMA disclosure rules, you'll find that the CFDs across the whole range of products goes from like 75 to 80% or sometimes higher across the whole range, where the customer makes a loss, where a retail customer trading their products makes a loss. So actually what they proved was that crypto CFDs were rather better in terms of customer outcomes than general CFDs and spread bets. So why single out cryptos for prohibition? The last point I'd make there is the FCA sample covered 18 months. They came out with this thing, but actually halfway through, or even more than halfway through that sample period, this restriction, the leverage restriction, came in where it said just do 2 times leverage on CFDs. Well, that was mixed in, and we aren't able to see whether what they already did in terms of leverage restriction had its desired effect. So why not take a sample that's purely of the 2 times leverage outcomes and see whether that makes it a more attractive proposition? All of this, rest assured, I put in my submission in the response. Also managed to get it into industry groups like Crypto UK and Global Digital Finance. All made a response along the same lines. And we did a separate one which said, and by the way, why are ETNs even in this study? Why are they even in the consultation paper? At this stage you might start to see why Coinbase didn't want me to stand up and talk from their perspective or with their stamp of authority. These are my opinions, and this is what I've represented to the FCA now. So what's coming in? From January, we're going to have 5 MLD. 5 MLD, all it did for crypto firms was to say certain categories of crypto firm will now become obliged entities under the 4th money laundering directive. So all that means is, at its most basic, it was just talking about fiat to crypto exchanges. Coinbase ticked the box. Custodial wallet providers. Coinbase ticked the box again. So we were definitely in. The HM Treasury extended, gold-plated those basic requirements and said, but what about peer-to-peer exchanges? What about crypto-to-crypto exchanges without these fiat on rails? What about crypto ATMs? The most ridiculous one, ICOs make sense, understand who's funding your development. The most ridiculous one was they included developers, so non-custodial wallets. Somebody develops a crypto wallet, loads it up onto GitHub, and anyone can bring it down, make changes to it, upload it again. And they're talking about subjecting those developers to KYC and anti-money laundering controls. Impossible. The problem is HMT hasn't come back and said which of these are going to be in and which are going to be excluded. So FCA, who are going to be the authorization authority, they can't make any guess as to where HMT is coming out. So they've actually said, well, just assume that they're all in. We'll assume that they're all in. HM Treasury might come in and exclude some, but basically we're going to be ready to authorize people in any of these categories. So potentially, if you do anything with crypto, you could have to do anti-money laundering KYC controls from the 10th of January. They've split out the registration. If you're already in that space, you can register up to a year afterwards. But despite that, you will be subject to having to do the AML controls from 10th of January. This is what the key takeaway, if you like, if you're in the crypto space. It's not enough. As soon as I was labeled on LinkedIn as Coinbase head of compliance, I got inundated with people saying, here's a bit of AML, KYC software. This will solve all of your needs. Don't be fooled into thinking that's enough. You can have your onboarding all nailed down, and you will still get the FCA coming in and asking for a lot more. I had a friend who had a recent FCA visit to look at their systems and controls. The first thing they said when they walked in was, "Don't tell us about KYC. We want to know. We know that you've done that. We want to know about all the rest of this. Have you got a money laundering reporting officer? Do they have a direct line to the board? Have you got a training program for all of you? Do you have external reviews? Do you have all of these systems, controls, policies and procedures in place?" Now, there's one of these which is very significant, and it takes some doing, which is transaction monitoring, which has to encompass the blockchain and try to peer through the fog of the blockchain as well. There's lots of people like Elliptic, Chainalysis, we've got Neutrino, will help you do that. But you need to have transaction monitoring in place. That's something that I probably can't help you with. That's really something that has to hook into your IT. All the rest of it, it's not difficult to pull together a fig leaf of policies and procedures, systems and controls that will actually keep you above water if you get an FCA visit. So all of these things, come up and ask me about it later. I'd be delighted to help you understand what it takes to do an AML risk assessment as a crypto firm, what it takes, who you should go to get this external annual review that's required. I just wanted to, there are various open questions on what's happening next year, but I just wanted to give a minute for any direct questions from the floor. Any queries? All right. I'll tell you one thing that you should watch out for, the travel rule, which FATF came out for. It sort of came out too late for it to be incorporated into the Fifth Money Laundering Directive and the Treasury's response to that. But this is a really iniquitous thing where you try to send some Bitcoin from one person to another. It goes from one address to another, which you might or might not know who that belongs to. Their idea is you have to know the identity, the person behind the origination and the person who's receiving the benefit of that. And that kind of turns the whole anonymity or pseudonymity of Bitcoin on its head and makes it very difficult to achieve. That's something we'll hear a lot about over the coming year. I think that Treasury was inclined to just slip it in at the last minute into their into the 5MLD implementation because it was on the agenda of a roundtable. But we never got around to discussing it, so hopefully that precludes them from putting it in. That's about all I wanted to say about what's happened in the past, what happened in 2019. Focus on what's coming up in January 2020, and I'll be very happy to help any of you who need assistance getting up that step. Thank you very much.